Hello, in this lecture we're going to define the term of a transaction. According to fundamental accounting principles, while 22nd edition, the definition of the term transaction is exchange of economic consideration affecting an entity's financial position that can be reliably measured. Couple things to note here is that we are talking about a exchange. So there's something that is going to be an exchange and it has to affect, of course, the financial position, and it is something that we need to be able to measure in order to record the transaction. Let's take a look at an example of a transaction where we have owner A and owner B in a transaction. Owner A is purchasing ink and purchasing it with not cash but an IOU, receiving the ink, the supplies, and providing an IOU in this case. Owner B then is providing the ink and receiving the IOU in this case. Note that there's no cash changing hands in this transaction, but we can still measure this transaction, and we still use the term of dollars in order to measure the transaction, meaning we know that the ink had a sticker price, we know that we owe a certain amount of money, therefore we can record the transaction and measure the transaction at this point. Also important to note that this transaction is happening between two people. Both people, in terms of the owners in this case, need to record their transaction for this event here. So for example, owner A would say that we now have ink, so the account of ink would then go up. Haven't paid cash yet, cash hasn't gone down yet, but we do have an IOU, and we would then record the fact that we have that IOU, which would be a liability. Owner B over here would be saying, okay, we have given up the ink, so the ink would then go down, that would be the inventory. There would be a cost of goods sold related to that inventory, and they received an IOU, so we're going to increase the IOU account, and we're also going to increase revenue because that's what was done in order to earn or generate that revenue.